Hi everybody, it's Mark here at Tesla, and as you can see here, Tesla closed red. The closing price was $262.59, which is a share price decrease of $3.91, or a drop of 1.47%. Now, there were times during the day where Tesla actually had some pretty good action, and you can see from this very apparent double top, and we'll talk about that in a second, that at 1 o'clock, it had a really nice 2.5% pump. It kind of sold off into the release of the decision for the Federal Reserve meeting, and it kind of climbed back up to almost meet that week equal high, but unfortunately it didn't get there. It doesn't really matter anyways, because the market then proceeded to sell off during the press conference. And then we talked about how the typical action of a day really looks like. Number one, during the course of the day, it's really not a great trade most of the time. I mean, Tesla had a good trade. If you caught that, I mean, I don't know who would have caught that. And by the end of the day, it doesn't even matter because it turned pretty red. But as far as the S&P 500 goes, it was a pretty flat day, even tighter than previous FOMC days. Now, that's maybe a little bit expected because going into this meeting, this was the lowest volatility that FOMC meeting ever had. It was only expected to have a movement of plus or minus 0.67% for the day. Though it was kind of weird because options are a little bit expensive for what they were, considering that small range, maybe that adjusted going into today or at the start of the day. But yeah, we can look at the S&P 500 now, and let's go on a smaller time frame. Let's say, how about a minute? And yeah, I mean, it's very, very tight. I would say this is what do you think this is, guys? 0.25%? Yeah, about just a little over, about just 0.29%. And that's super tight. And it's kind of makes it all kind of worthless too, because buying options at the beginning of the day, they would have faded by, 20% just because of, theta alone. And you get not even a great entry for a long. Like, I was looking at this and I didn't enter a long after the decision was released. Because if you look at this like drop, it's 0.5%. I'm not really interested in that. And plus the action was very not comforting or compelling, getting to the point where it was reaching the kind of like the pre 2 p.m. pricing on S&P 500, and it just kind of stalled out there. And I actually entered a short going into the end of the week. It wasn't a perfect entry. I honestly think I actually added it during this flagging action during the wait time before the press conference started. I mean, if you want to know, it's a small short on the semiconductor sector. So I have a short there, and we've talked about it yesterday even. And so I hope you guys kind of were prepared for the movement. It's okay. So what are we talking about? We have like one move one way. We have like a corrective move the other way. And the first move is replicated with the third move. So it's basically, it's essentially one move, but it looks like it would either look like down, up, down a lot, or up, down, up a lot, right? We talked about that. So it's flat until 2. It has a move. It maybe corrects a little bit and probably goes the other way. And that's what happens sometimes. And I think you kind of have to kind of play for that, especially if if you just listen to the speech, if you look at the dot plot, the Federal Reserve was, some people call it hawkish, and I would say it's hawkish. I think it's fake hawkish. I think at the end of the day, no one thinks there's going to be any more hikes. But the thing is, no one thinks now, and we'll look at that in a second, no one really thinks that we're going to have cuts as soon as we thought we would have cuts. Now, we'll talk about that in a second, but let's look at the action just to confirm if we saw what we thought we would see. Number one, we talked about we had this cup and handle pattern. And what do we talk about the cup and handle pattern? It's probably going to break one way or the other. And I was like, up here, which would be kind of getting to the bottom of the gap, or down. And the reason why I go down is because we were going to make a significant low if we were going to break to the bottom. And actually, we were pretty much dead on. I think it really touched 438. So good for us, right? I mean, we kind of predicted the move. I never know like what direction it's going to go. Like who knows that? If people knew what direction it was going to go, we would all be rich, right? But we can kind of understand where it wants to go when it goes in that direction. And that's kind of what I hope that you pick up from this. Is like, I'm not pretending I know where it's going. But what I can tell you sometimes is it's going to stop somewhere around here or go over around there and kind of stall out. I think, and that's not predicting anything. It's really just based off the idea that, number one, the environment that we're in is what do we say all the time? This is like the worst time of the year. So the only people that are surprised, I guess, would be maybe people who are like recently started to trade, and because this is bound to happen. I mean, even the biggest bulls in the world, like Tom Lee from Fundstrat, he's not exactly the most bullish guy during September and August. He's just not. I think he even prefaced it that it's going to be bad. And so it's not me saying that everyone needs to sell everything, but we talked about the motivations, why this is happening. And now that we're going down, maybe no one knows. And we're going to look at the other FOMCs again, but this time we're going to focus on the day after or like whatever couple days, whatever looks significant for FOMCs in the past. But what needs to happen now? So let's say we could jot the percent, but that's not enough. Like if you are, like we talked about yesterday, if you are a fund manager and you need to get like 7, 8, 9% by the end of the year to beat the benchmark, because if you were dropping during the spring because you were just incorrectly positioned and the S&P 500 goes up like 10%, you need to probably get 10% with today's and yesterday's and previous couple days move. They were probably short since last week. Okay. And then you got a couple percent. Like what did they get? If they were shorting the S&P 500 and they had like a perfect entry, they are now good for 2.6%, right? So they kind of want to get 10%. So they're like 1/4 of the way there. Like what do you want to get? How much do you want to get going lower for the next couple weeks? Maybe another 2.5%. And it would really kind of play out this really weak looking head and shoulders pattern. But something like that, like maybe to the top of this range. What is that going to look like? To the top right here, you see that? 4%. Maybe we get 4% to the downside. I'm not sure. Going below that, then you're going to start making, in my opinion, significant lows. Like obviously you're going to make a new low if you go past, 433. And that's not necessarily a bad thing. But I think if you were to get to this point where there's a consolidation and start making lows below that, I don't know. I don't think it's that great. I would say this right now, though. If you entered your short today, I applaud you because, why not get a hedge on Tesla? And I'll talk about it in a second. Because you had 2 opportunities to do it. If you had 2 opportunities to do it and you didn't do it, I don't know what's going on. Because we talk about the hedging all the time. We're going to hedge until you see a very obvious short-term trend that you don't want to get kind of steamrolled by, right? What is our short-term trend? Our short-term trend is nothing. It's really nothing. Looking at Tesla, what are we looking at? This is sideways. This is nothing. This is actually to the point where you're going to threaten a low if it opens up pretty bad tomorrow. No, but it's really good. Okay, looking at the chart, like I always say all the time, like you want to like scare people, like getting to the top of the gap and get away from that, which is what happened over the past couple of days. You kind of get to the top of the gap, you get away from it, you kind of almost even close the gap above. What a crazy move, right? Guys, you had 2 opportunities to get in on this hedge. You had 2. Now, what's kind of cool is that, and some people don't think it's cool, but I think it's cool because it's definitely more like a reversal of what you typically see. Now, typically what you see is after the close, Tesla sells off like $1 or $2 after the close. And what's happening now is actually it's like almost $1 above its close. Whereas go back to the S&P 500, the S&P 500 is actually like 50 something cents below the close. And there is, you can, we'll talk about this more in the future. This keep playing this out, but which we were looking for, what the seasonality of Tesla and S&P 500. The seasonality is S&P 500 goes down, Tesla stays flat. Now, flat doesn't necessarily mean like, oh, you're just like flat every day. Maybe the flatness looks like, oh, it's negative 0.5% instead of negative 1%. You know what I mean? Like just a ratio that's just slightly better than the index. Can we get that? I'm not sure. Like we're really not sure. There's still a lot of pricing pressure. There's still a lot of margin pressure. Who knows what the market really thinks? And at the end of the day, we can't really do anything about that. Let's briefly look at the day after FOMC, especially days that have like really strong sell-offs, right? Like when the sell-offs are severe. I think we actually saw a good example of that before I went to a smaller time frame. Let's see. Where did I catch that? What even month am I in? Okay, so we have this one from July. So this one had what? It was kind of more of like a flattish day, and it kind of bulled pretty hard after. So I'm not sure if that's going to be really relevant to us because it doesn't really match up with our price action. That was mostly flat. So here, oh, this is a strong sell-off. Okay, so we have this move. It's kind of flat throughout the day, and it kind of consolidates and boom, sells off. It has a pretty dramatic sell-off. Let's say try to find a good medium point, just slightly above the open. And let's say it sold off 1%. Okay, and then it gaps down the next day and it sells off right in the morning. It sells off another 0.7%. It sells off another 0.2%, double bottoms, and then in a couple days, 2 or 3 days later, you get a gap up and you just start going up. Okay, so there's some continuation for weakness when we have a big sell-off. Let's look for another scenario. Okay, so this is a pretty big sell-off. You have that move up, down, up, down. That's a crazy day. Can't imagine that one. But let's say from the high, 2.5% drop. From the open, 1.5. Okay, so what happened the next day was people were like, yo, this is cheap, right? Okay, let's buy. And you get a big gap up, 0.8%. You get bought up another like total of almost 2% on the day. And guess what happens? Boom, you get freaking destroyed. It drops 2.5% within a day. So there's continued weakness for 2 days, 3 days so far is what we're kind of looking at. Let's keep going back. Okay, so this is the opposite. So you kind of get this flat move across. You go down and you go up and you go down and you go up. And you just have kind of some strength for a day before it starts kind of consolidating and selling off later. That's just consolidation for like weeks. Anyways, that's boring. Okay, so this one is flat for the day, sells off, gets bought up, and just sells off for forever. Okay, so the weakness here on this is from December of last year. That's just continued weakness. Though from a seasonality aspect, it might be relevant because December, at the end of December, can be pretty weak. And I mean, the beginning of December can be okay, but the end of December may be pretty weak. And you can compare that to now where going to October can be pretty weak. Maybe you get further weakness from here. But yeah, it was a special case at the end of last year because they did not care about our inflation number in December of last year. That was traumatic for me. 5% drop from the close over the course of a week in December. Okay, here's another one. We have the typical fake out in this one. So it's sideways, up, then down a lot. And then it gaps down the next day. So we're seeing a couple examples of gap downs on the next day on a sell-off on FOMC. And it kind of took about 2 or 3 days to find a base after that. And it went back up a little bit. But yeah, this is November. Let's see if we can look at if we have one outline for, here we have one outline for September. So we're going to have kind of like a correlation. I mean, the inflation setup, I'm not saying it's the same, but we have inflation that's a little bit of an acceleration going to it. And this is kind of your perfect FOMC pattern. What does this look like to you? What does last year's September FOMC look like to you? I mean, now I'm going to measure it. I'm going to measure the intraday movement. So it's 0.4%, so it's tighter. You have the drop, right? It doesn't even get bought up. It's just a straight drop. This one actually has it when the recovery makes a high, and then it sells off completely. And it sells off completely to the tune of around 3%. It doesn't gap down the next day, but it does sell off in the morning and stays flat, sells off the next day. Doesn't get a base for 3 days, maybe. Yeah, on the 3rd day, 4th day, still the same price. 5th day makes a new low. So this is like a week bottoming process. And what would a week bottoming process get you for this September? It would kind of get you the same scenario. I don't know why I changed the time frame. Not even know where I am. Okay, let me see if I can get back there. Just bear with me. This is December. Okay. And here's the November one. Okay, here's the September one. So this is what we were looking at. We were looking at September's and October's maybe a week ago, showing the weakness of September on a pretty typical basis. So this is the FOMC. It sells off and it continues to sell off for a pretty decent amount. Over the course of 21 days, it dropped 7%. And there was a couple moments where people probably got scared out of their puts, but eventually if they held on, they would have had a nice return of 7% on the S&P 500. I can only imagine what other tickers, hello, Tesla, during that time would have gotten you a better return for a short. I'm not saying that we all need to short everything. What I'm saying is that why not just hedge a little bit? Going into the worst time of the year, maybe hedge a little bit. Currently, we're seeing that every time we have a sharp sell-off on the FOMC, it doesn't really bounce back very quickly. I'm not saying, again, that it's going to be the exact same way. What happens tomorrow if we gap up, you guys are going to scream at me. But there are scenarios actually where the price gaps up. We saw that. And then it sells off again after the gap up. So I don't know. All I want to know is that we've talked about it repeatedly over and over and over again. It sucks. And it's showing it sucks. It's showing it sucks every day, over and over and over again. Now, Tesla is kind of acting in the way that we thought it would too, where it's generally, right now, as you can see, it's generally flatter. I think eventually with enough downward pressure from the index, the QQQs and the SPY, it can eventually close the gap. I don't know when, I don't know if it's really going to happen. That's a pretty significant drop. We're talking about $14 a share. I say that again as well, but at the same time, a 5% move to the downside, you can do that in like 3 minutes. You can do it at the open tomorrow if you wanted to and just get it over with. Just get it over with, guys. And plus I have puts. And I can cash out the puts. Anyways, we're back on Tesla again. So we confirmed FOMC. There are certain scenarios where the sell-offs happen, and then most of them continued to show weakness. And now I'm not saying it went down a lot, but weakness after the FOMC sell-off, with one FOMC that showed that there was more stability and more flattishness. I don't want to use the word bullishness. It didn't look very bullish. It was a gap up, bought up 2%, sells off. So just be aware of that. So the move on tomorrow. So let's go back to S&P 500. If you get the gap down, let's say you're gapping down to here. And what does that move? I don't even know if that's realistic for the S&P. Let's see. What does that move? Oh, that's 1% on the open. I don't know if it's 1%. Okay. Basically, just watch your levels here. Go to your trading view chart. Just draw these two lines, and you can use these as a reference point to understand when new lows are being made. I'm not saying that you need to go along when those are hit, but they might be relevant. What about to the top side? I mean, you can whatever the top side. I mean, what we saw was what? What did we see on the gap up that we saw during our historical study of FOMCs? When there was a gap up, it was about halfway from it gapped up to the point where it was about halfway up from the sell-off, and so it's something like this. It was like that. It looks something like that. Could that happen? Yeah, maybe it doesn't want to make a new high. So why would that happen? Number one is if you were, once again, a money manager type of person and you got a nice move on FOMC, but in your mind is I'm not done yet. I'm still selling. I'm going to sell for a week. Well, what you want to do is you want to have another great entry for more shorts and scare more people out of their positions. So maybe it gaps up a little bit because, the European Union showed that they have a little bit less inflation than expected. They had a much stronger day in the market than we did. Obviously, they weren't really open during the release of the FOMC decision. But so if you're a money manager, would it be kind of cool? Your shorts that you might have now, or maybe you close them out. Anyways, maybe the shorts you have now would suffer right at the open. But the idea is to buy more shorts, get more shorts in, and then sell everything you got and kind of start a cascade of pricing. Because the thing is, there's a lot of people. So the money managers who have made money, the people who bought tech in January, well, they're still sitting kind of pretty, right? It's not like they're suffering right now. They're not doing too bad, but they need to come to the decision. They need to make a decision. Okay, we'll look at the QQQ. This represents And you can see the QQQ is also selling off after hours about almost $1. And remember, let's look at Tesla again. Not selling off $1. Now it's coming down a little bit, but still slightly positive. Okay, let's look. Let's go a long time frame on NASDAQ to try to find that, to maybe go for a day. So here's the daily. Look at this destructiveness. Now, we're going to look at, okay, I'm not saying we're going to short, but if you're going to short, what do you want to short? That's your question, right? That's your question. If you want a hedge, do you just short Tesla? But the risk is what? We talked about the flatness of Tesla. But can Tesla really stay flat if the rest of the index is selling? It's going to need a crazy catalyst to stay flat. But let's look. So this is January 4th. And if you bought the NASDAQ on January 4th, heck, even if you bought it the week after, you're probably sitting at a gain of the year for around 30-something%. You saw almost 40%, 40-something percent just a couple of weeks ago, but you're sitting pretty. You're beating the benchmark severely. So you have to ask yourself, if you already win, or you're already winning, and you saw the action today, what do you do tomorrow? You want to preserve your gains for the year, right? So the story that the people who need performance, they're going to create stories that make you get out of your position. So you can preserve your gain, and you can preserve this great look you have for your clientele. All those mutual funds that have 41, 42% gains, all the money managers and all the ETFs that are doing great, they're going to make a decision for themselves. It's going to be like, I'm going to get out now. I'll buy back in if there's a low in October. That works out for you, and that works out for the people who need performance, who need to get the price lower, and then boom, maybe run it up to the end of the year after you get like a 5, 6, 7, 8, 9, 10% move to the downside. Okay, so it's like you create the story, you scare people out of the positions. They're not trying to scare you out of your positions. You don't have enough positions to be scared out of. Maybe as a collective whole, that retail are swinging some couple million shares, but they want to sell the story to the people who already won, not us, not their compatriots, the people who already won. And that's who's going to be selling. And that's the type of person that can really drive the market to like a VIX 20. Right? Do you know what I mean? Like, what is the VIX now? 15? Okay, so just keep that in mind. That's what we're looking at. Now, we'll look at Tesla again. I want to say I didn't get the short on the first go around. Actually, I wasn't even really paying attention. I was making a YouTube video. So it got bought back up. I kind of saw it in the corner of my eye, like, oh, that's really green compared to the rest of the market. That's like a 2% move. And it kind of sold off going into the meeting release, right? The decision release. And then it got bought back up during the press conference. And I actually entered a short somewhere around 273, I think. And that thing went up like 280%. So it gave you two opportunities, right? It gave you two opportunities because can we plot the S&P 500 on top of not SPY. Let's just plot it real quick. And you can see that. Yeah, for me, it seemed obvious because generally it was a very weak kind of curve. And I didn't want to get caught with Tesla, selling off 3 or 4% and not have a short for it. I would kick myself. Guys, you had two chances. It's like an obvious double top. And as far as like what level to respect, okay, it didn't even stop really at what we thought it would, at the 271, which would be kind of the bottom of the range. It actually went to almost close the gap. And I really hope you're looking at a scenario like, oh man, this is $273 a share. You want to do something about that. You really want to do something, but you can't just be like, oh, this is great. I'm a bull and this is awesome. You got to look at the environment. You got to look at the environment. Even if you're not there to read or listen to the Jerome Powell speech or even look at the release, you have to understand. We've been talking about it. This time sucks. Now, why did this happen? Okay, it went up a lot, but why, right? A lot of people are like, oh, we're going to wait for the news to be released. No, I think it's a little bit different. I think this is a rotation. This is a rotation. Okay, so there's some truth to the matter that some people are saying, like, look, it's front running a positive, like dovish Fed. I don't think anyone that knows anything about the market is thinking the Fed was going to be dovish. Nobody. They cannot signal to you that they're going to cut. They cannot do it. Because then you're just going to go about and buy everything. They're not going to do it. Okay. Now let's look at a chart. We're going to go to NVIDIA. This is NVIDIA on the 5-minute. Orange line is what? Orange line is Tesla. Okay, so this is 1 o'clock. Now, the market wasn't like going crazy selling off at 1 o'clock. It wasn't going to do that until the meeting happened. But NVIDIA dropped the percent. Then Tesla, at the same exact time, rose 2%. Right? We're all hearing about all the FUD of Jensen Huang like selling a bunch of shares, hundreds of $millions of shares. But the reality is, it's just, this is the rotation. This is an obvious rotation. Now, it's not like a market-wide rotation. This is a couple people that said, you know what? I want out of this name. NVIDIA's up 1,000,000%. Tesla's still down 40% from its high. NVIDIA made a high that's 1,000,000,000% above its previous high. So the timing is very obvious to me. It's very obvious. NVIDIA was weak from lunchtime into the close. Do I have a short NVIDIA? I do have a short NVIDIA. I had a short NVIDIA since last week. And also, by the way, transparency, I also have shorts on this on SMH. Okay, so you see the pump. And then that pump is just like some people saying, okay, yeah, maybe they do believe that the Fed would just surprisingly be what? Quite dovish. And what move do you think? You think NVIDIA is going to go up more than Tesla? NVIDIA would not. Okay, if the Fed was dovish, NVIDIA is not going up more than Tesla. Okay, Tesla's a rate sensitive stock. NVIDIA is not rate sensitive. It's just people are throwing money at NVIDIA with cash. You know, we're talking about VCs, Microsoft, Google. They have cash. They're throwing money at NVIDIA. So it's not as rate sensitive as Tesla. So if it is a dovish play, you want to be in Tesla because they're trying to get people to get loans to buy cars. No one's getting a loan to spend 50 G's on H100s for their personal home. No one's doing that. But they are doing that for a car. Let's look at the news real quick. The only news is FOMC. That's it. Powell said the word carefully. The words proceed carefully 6 times. And this is just another sign of we don't know what we're doing. We're scared to do anything. All the banks, all the institutions don't think they're going to raise rates again. And now it's just the idea of how much longer are we going to stay at 5.5%? Good question. Let's look at CME Fed Watch tool to find out. So there's no more September meeting on the tab. So we have November as the next meeting, and you can see unchanged, basically unchanged, right? Let's look at December. December has a slight uptick on people thinking that we'll have a hike by the end of the year, but it's only like one person voting for it more. Not a huge change. What I kind of want to get to is like we were looking at March, right? March had yesterday a 54% chance of staying flat, but also a vote or two of people thinking that we'd have a cut. Less votes for a cut by March. Let's look at May. May has most of the people, of course, thinking it will stay flat. Makes sense. Losing votes for people who think we would have had a cut. More votes being moved to a rate hike, meaning that rate hike would occur before the end of this year if we were to have that, by the way. Most likely, is what I mean. I don't know. And so going into summer, we have less votes again for cuts, though the percentage for the cuts is about 27%. About 1/4 of the survey participants believe that cut will happen instead of 1/3 just yesterday. Now looking at July, so we're going to have more people think we're going to have the same rate, okay? And slightly less people think we'll have a cut. So I think this is your kind of transitionary period where by maybe the end of summer, you get a cut. Now let's look at September 24. Then these numbers are just people betting on the idea that rates will come down. And you kind of see that there was one more vote for a hike. to stay all the way to September, but most of the people are basically anticipating a cut by fall of next year. But you remember, guys, it's September 23 now. A cut 1 year from now, things are going to be hurting, and not just stocks, bonds and everything. You're going to have rates the yields on bills and bonds. They're going to be 5-something%. That's going to kill stocks. And the thing about it is you don't have anywhere to go. There's nowhere to go. What are you going to do? You're going to go into gold? Why go into gold when you have 5% rates on bonds, and you don't have to worry about any type of volatility when it comes to gold? It's not like gold's moving up 40% in a month. If you want to catch gold, you can catch gold. Sell your bonds, buy some gold if you feel that's going to happen. But gold is not as attractive if you have what people are perceiving as a bottoming of earnings, okay, at the middle of this year. So the banks and institutions, they think earnings will start to grow, okay? Not Tesla's, obviously. No one cares about Tesla's earnings. Everyone thinks Tesla's going to the tank. Okay, so you have a bottoming of earnings, and then you have higher yields. And that's what people would say is a resilient economy. Okay, what's a weak economy? You're going to have earnings go down, yields will go down, and then it's because people don't have money. They're going to drop the rates. So that means bonds and bills rates will also drop. Then bond value will go up, right? And then we all lose our jobs. But anyways, so just think about that. If that's a real possibility, and you'll probably get some clarity on this idea over the next week as you can see the price action in the markets. As it exhibits further weakness, you're looking for an event to stop the weakness and stop the selling. But what does that event look like? The only chance you have, in the short term, meaning 1 week, is PCE next week. That's your only chance. Otherwise, it's going to be a black swan event that kind of solidifies the case for earlier than expected rate cut. You know, there's a lot of people that believe that an economic situation, be it here or abroad, will happen before the end of the year and are anticipating cuts before the end of the year. But remember, every time the cuts happen very unexpectedly, it's going to be a sign of a recession. That's basically how it always worked. So if cuts happen more based off like the anticipated date of the cut, then that's just meaning like, yeah, the market is able to sustain itself. The economy, is able to sustain itself until that point in time. But can we last a year? I think it begs the question, can the government last a year paying out debt, paying out a percentage of the budget that is higher than the defense spending to maintain our debt? We're already doing that now. We're already paying to maintain our debt in the United States of America. We're paying probably $300 to $400 billion more than what our defense budget is. And everyone likes to think of the defense budget as this exorbitant figure, like $850 billion. Like for what? People say all the time, we don't have a war. Obviously, they don't understand that that money protects other countries, whatever. But to manage our debt, it's so expensive. Okay, so at the same time, I would say this too. If you could last a couple months in this market, what the reality that Biden is going to face is that he doesn't want to go into an election year where the economy is stagnant. The economy will be stagnant with the higher rates. So that kind of goes to some people's calculation that you get a cut. But who knows? Okay, so let's talk about, before we end the video, let's talk about what do we do about potential weakness. Because, okay, I always say this all the time. If the market goes up, perfect. You're already long. You have a bunch of shares. You're long, you win. Perfect, great, fantastic. But if it goes down and you don't have hedges, what do you do? Because it's been proven to you this year alone that it can go down for a very long time for no reason at all. We know there's a reason. We talk about every reason. Obviously, we know what the reason is. What I'm saying is that you talk to other people. They're like, why did the market go down? And they can't explain it. But we know why. We know why. Okay, so what do we do about it? Well, I think you get a retracement on VIX. So let's say on Friday, VIX comes down to like 14.5. But we know that when things go really bad, the VIX will get to 20 in about a day. right? Like here's a long-term time frame on the VIX. Charting the VIX is stupid, so I don't recommend anyone do it. But let's just say for fun, we'll chart the VIX. And what does like a typical VIX spike look like? Meaning like how long does it take to cover a particular distance? So let's say that we're looking at March of this year when we had a lot of weakness for the spring. Over the course of like no time at all, how long is that? A couple days? Yeah, I'm thinking it's like 2 days. It goes up 59%. What does 59% look like from tomorrow? Let's say there's a small retracement tomorrow and you want to go along with the VIX. A 59% move on the VIX, that looks like 22 on the VIX. I'm just saying, like, if you need a hedge, I'm not recommending anything. Okay, what else can we do? Obviously, you can short Tesla. I have a short on Tesla into the end of the week. So I'm not saying that's the best play either, because duration is sometimes more important than cheapness, right? Having duration on your hedge can just be a little less maintenance if you know that you're going to get a lot of weakness. I would say if you mostly own Tesla, people ask me all the time, what should my hedge be? First things first, I think your hedge should be a direct hedge. It should be a counterplay to whatever you own the most of. That way it's just more assured to protect your downside. Because imagine this. Imagine like you're like, you know what? I think Tesla's going to outperform the QQQ. And then you're like, I'm going to short the QQQs and I'm going to stay long Tesla. And the next thing you know, tomorrow, Elon Musk, he decides, you know what? I'm going to do a price cut on the Model Y. I'm taking that thing down $5,000. And you're like, oh crap, Tesla stocks can go down 12% in one day. And then the QQQ stay flat. And you're like, whoops, I don't have a hedge. So first things first, I think if you want a hedge, that's going to be a counterplay to your biggest holdings or whatever you're trading, basically. But as far as overall weakness, we already look at the QQQs. It's flying really high. It had a 40-something% move on the year, 48%. What do you think this goes down to? I don't know. What's a typical retracement, guys? Like a 40% retracement? Let's say you get a 40% retracement. Let's drag the fib, go down to 0.618. That's going to be, I don't know what I'm doing. Let's drag it from the actual close. If you drag it from the close, it's like a 7% move to the downside. But everyone's going to say, if there's weakness tomorrow, everyone's going to be like, we're closing that gap. And you're like, okay, I mean, why not? Let's close the fucking gap. And then you'll be like, okay, it's going to be a 9% move to the downside. I don't know how long that would take. That might take a couple weeks. If there's weakness. I don't know if there is, guys. I don't know. Because you can tell me right now, like, bro, I see a bull flag right now. I'm like, okay, you see a bull flag? That could be, I'm not saying it's not. It's not like this flagged to anything. I mean, this kind of did. It kind of made that, and it went up. So I don't know. But QQQ, maybe a short on QQQ can help too, as far as like, and the reason why I think about the NASDAQ and the S&P 500 via SPY as hedges is because they're more volatile. Only for one reason and one reason alone is you can get 0 date to expiration options. And I'm not saying you should do that. A lot of people lose money on it. I'm just saying if you're desperate, the indexes offer you shorter time frames on these plays, giving you a little bit more volatility if that's what you need, meaning that you can use a smaller amount of money to get a better return for that move. Like if you buy a QQQ hedge for next Friday because you want duration and the market drops 1%, like sure, maybe your put goes up, 300%. If that was a 0 date to expiration option, maybe it goes up 900%. And for like $1, So Qs could be the way to go. IWM, Russell. Oh. So we drew out the head and shoulders. It's playing out because it's breaking below the neckline. So here's the neckline. You're basically collecting the 2 dots that would be at the connection points of the shoulders and the head. Head being the bigger part, shoulders. So maybe you're cracking below the neckline. Where does it stop? We talked about this many weeks ago. If you want to hedge to the downside, maybe you can see a retracement of 6% in a very short time on the QQQ. What does a short time mean? Well, kind of look at it like this. If you are trying to go along the Qs here, back in like when we had that whole AI revolution, let's look at how long it took to go 9%. It only took 6 days and 23 hours to go 9%. So a week, you can get that move of 9% if things are going really good. How about like when the banks were imploding on themselves? What was that move from this high here to just the next low? It's an 8.71% move, all done within 4 days. Okay, so IWM, possible to wait to supplement if you're looking for more dates on options, because the IWM has 3 dates, Monday, Wednesday, Friday, and then QQQ, Dow, and I think the Dow, the DIA is actually not every day. So QQQ and SPY, or the SPX, or the futures with ES could be options for you if you're looking for a little bit of like a last minute hedge. VIX is also available sometimes at extended hours if you'd like the VIX. How do you hedge your hedge? We talk about hedging hedges all the time. It's just really entering along when you get to a low that seems like a dramatic low. So you can stay, let's say you have duration on your short. You have duration on your short, you buy a bunch of puts until next Friday, and then next tomorrow, it's like, oh, negative 2%. If it's negative 2%, you can buy a short-term call going into Monday or something like that, and you can like hedge your upside, because we've seen on our little review of FOMCs that even though we're like selling off for a while, what was that, in October? Okay, in September, like you're selling off for a while, but there's moments in time where you see a significant rally. So you get, imagine if you're here like, man, I'm having a great time. I have gotten a short for the past 9 days, and it was -5, negative 6%. And all of a sudden, within 1 day, it rallies a considerable 6%. You're like, my short is worthless. And you're saying to yourself, oh my God, I missed out on that whole move. I didn't sell, only to find out within the next week that it goes down another 8%. Right? So you can kind of like, if you find significant lows, you don't necessarily have to get out of your hedge if you have good duration. It's just, be open and be flexible and manage your trade. Don't be like, I hedged, I can walk away from it. We talk about it all the time. The moment you take a hedge, you are actively trading whatever you're trading. That's it. That's it. And I honestly recommend, if you're listening to this video and you tell me you don't have time to look at Tesla every day, you do have time to look at Tesla every day. I promise you, you do have a minute or two to look. I promise you, you will. If this is your biggest investment, if it's the largest share of your investment, I hear it all the time from YouTubers. They're always like, I never look at the intraday movements. I never look at the short-term movements. I bet they do. They can't help it. I know they do. Because when the stock goes up, they're already talking about it going up. But when it goes down, it's like, I can't bother myself with the short-term intraday movements of Tesla. No one can predict it. No one's saying anyone can predict anything. But if you watch the stock, if you own the stock and it's like 95% of your holdings, and you've been holding onto the stock for the last 20 years, and you're telling me you don't understand the movements of Tesla, I think you're lying. I think you're lying. It's very obvious how it moves. It's very obvious. I don't know where it's going to end up, but how it moves, I think it's very obvious. Okay. I think that's all I can talk about for now. This is much longer than I expected it would be. I'm sorry. But no news today, just FOMC. Hopefully, what we talk about doesn't really play out, because then stocks go up forever. But if it doesn't, I've been saying it for a week and a half. Be mentally prepared for the weakness. All right, guys. Thanks so much. Bye.